Guys, welcome to my channel. Today we'll be talking about inverse fair value gap. I know you're familiar with other confirmation entries out there, like the optimum trade entry, the break of structure, or the change of character. But this particular entry confirmation happens almost every time. And today I'm going to teach you and break it down on how I find this kind of setups. Okay, so look at this image here. First, we have some set of bullish candles, and then we have the break of that candles, like the fair value gap was not respected at first. If the fair value gap was respected, price would have reacted and traded back up, but the fair value gap was broken. Now once price is coming back again to that place, it will remember that fair value gap. That's when it's an inverse fair value gap. It will remember that, oh, there was a fair value gap there, and react to it before trading downward. So that's this point is your entry. At that point, that there is your entry. Okay, so we are going to look at the charts and find out where does this inverse fair value gap happen. How can we pick trades? How can it be this so precise, right? So let's look at Nasdaq. So first, we look for a read of a buy side liquidity, right, or a sell side liquidity. So first we have this buy side liquidity, which is obvious. Then we have price taking out that buy side liquidity. So in cases like this, you want to look for a confirmation entry, right, like the optimum trade entry or the coach or the fair value gaps or the BOS. And trust me when I say that the very best entry to be looking for here is the fair value gap or the inverse fair value gap. Now what you do is go to the 5-minute time frame. You want to break down to the 5-minute time frame. You can see that if you're waiting for a break of structure, you will not get any entry, or the coach or the OT, you will not get any entry. But in this case, price rated that high, and we are looking for what, a fair value gap or inverse fair value gap. So there is no fair value gap here for us to use as entry. You can see all of these zones where this displacement is happening. There's no fair value gap there. What do? We look for inverse fair value gap. So you can see there's an inverse fair value gap here on the left hand side, which price did not respect. Now look at this very well. Price left that fair value gap, traded downward, and break through that fair value gap without respecting it. If price wanted to respect that fair value gap, it would be something like this. Then only if you see something like this, that is when that becomes a normal fair value gap, but not an inverse fair value gap. But since price is not respecting that fair value gap, it will be used as an inverse fair value gap. So price does what? Leave that fair value gap, break upward, take out that buy side liquidity, now break downward. Now once this break of the fair value gap or the inverse fair value gap occurred, that's your entry there. That is your entry, and you can see how price is perfectly respecting that. Price does not go beyond that fair value gap. So you pick your entry, stop loss at this candle's high, and take profit at the next low. You get yourself a forex to reward there. So you can see how this inverse fair value gap works. Price does not need to respect that fair value gap for it to become an inverse fair value gap. Note that if price is respecting a fair value gap, then it will not act as an inverse fair value gap. Price must break through it, then retest on that fair value gap. Now let's look for another example. Okay, here's another example on Nasdaq. We have a buy side liquidity here, relative equal highs. You can see that relative equal highs, and what you do is you expect price to take out a buy side liquidity. We all know that, like a previous day high or a previous day low, which is sell side liquidity. Once price take that, you're looking for what? An entry. So first, there's no entry here. You can see all of these consolidations happening. If you check very well, there's no entry there, there's no fair value gaps there, there's no inverse fair value gap to even tell you that price is ready to buy. But if you look closely, there's a fair value gap here. Let me shift this to the left. If you look closely, there's a fair value gap here, and since you are looking to do what? To sell, and you see that price is not respecting that fair value gap, just look at it. So price leaves that fair value gap, breaks downward, breaks upward again, and breaks downward. Now this is telling you that that is going to act as an inverse value gap, because price is not respecting it right at first. Then price retraces down, retraces back to that inverse value gap, and trades down, and this becomes your entry. Stop loss on the nearest high, and your take profit on the next liquidity, which is the next low or something. You can see this is how you take, this is how you get forex to a warrior share of trades without using the break of structure, without using the change of character or the OT. This alone is a very good entry confirmation for you. So once you have price take out that buy side liquidity and you see this, that is your entry. Let's look at one more example, this time on US 30, not NASDAQ. So this is US 30. It's very important to know that I use this inverse value gap on the 5-minute time frame, but that does not mean that it doesn't work on any other time frame. It works on any other time frame, but the win rate of it working on the 5-minute time frame is very high. Out, I mean, you can still see it on the 15-minute time frame. You can still see it on the higher time frames or the lower time frames, but I like using a 5-minute time frame. Once price takes out my buy side liquidity or the sell side liquidity, I'm looking for this type of entries. It does not mean that I'm looking for only inverse value gap. No, I'm also looking for the OT. I'm also looking for a normal fair value gap. But in a case where there's no normal fair value gap, then I'll be waiting for the inverse fair value gap, right? Just like this. So we have price take out this buy side liquidity. Then what is next? You're waiting for an entry, right? Now you see that if you're waiting for a normal fair value gap here, price did not leave any. The next fair value gap price left was here, and that means that if you are taking your entries here, you will miss all of these trades before coming to take entry at this fair value gap. And there are people who trade like that, but I don't do that. I want to take entry from the very first move, right? The very beginning of the first move. Now what do? I will look for any fair value gap on the left that was not respected. Well, we have one here. You can see this fair value gap was not respected. I draw it to the right. There we go. So first you want price to do what? To break the fair value gap to become an inverse fair value gap, taking out the buy side liquidity. And if you are selling, since you are looking for a sell, you want price to break this fair value gap. After price does that, we wait for a retracement, and this is how you get sniper entries, right? So after price breaks that inverse value gap, we wait to take a trade and stop loss on the nearest high, take profit on the next low, and that's how you get 6 weeks to reward ratio. Very simple. Trust me, this particular entry strategy have been working for me for so long now, and I decided to share. I made a short about it, but it was not enough, so I'm making a video on it now, and I'm going to also make videos on other entry patterns that will give you good risk to reward ratio and good win rate. But for today, go and study this particular entry, which is the inverse value gap, master it, and let me know what you think on the comment section. So until next time, be safe.